Wonderful, wonderful. So again, good evening, everyone. Thank you very, very much for joining us today. My name is Laura Nieves. I am Director of Investor Relations here at Astor Realty Capital. It is truly a pleasure to have you here this evening. Every time one of these do these sessions, I'm truly impressed by the turnout. So thank you so much for taking the time. For those of us who are joining us for the first time, Astor is an institutionally backed private equity real estate firm. We have offices in Manhattan and Miami. We specialize in value add and ground up developments across major US markets. And we currently manage over $3 billion in assets, spanning more than 4.7 million square feet of commercial and multifamily properties. We created this GlassDoor series because we believe transparency is a core pillar of investor trust. These sessions are designed to give you direct insight into Astor's investment strategy, portfolio progress, and like tonight, access to leading experts who can help guide you to smarter wealth building decisions. This evening, we are proud to be joined by two fantastic guests from Sound Private Wealth, which is a subsidiary of Equitable Advisors. We have President Ferdinand Ruplin and President Nicholas Meoli. They're going to bring us tonight a wealth of knowledge in financial planning, tax strategy, and retirement optimization. Together, we're going to explore how to leverage real estate's built-in tax advantages, structure your income across tax brackets, and keep more of what you earn. So tonight, to kick things off, I'm going to introduce Astor's CEO and founder, Joe Berko. Joe is a highly esteemed entrepreneur with over 30 years experience in the real estate industry. As founder and CEO of Astor, Joe has propelled our firm to the forefront of the private equity real estate world. Astor, as mentioned before, we specialize in lucrative investments across major US markets, and we employ a strategic blend of equity and debt structures to maximize our investor returns. Today, as I mentioned earlier, we have participated in over $3 billion of diversified US assets to date. So on that, Joe, I'm going to hand it over to you.
And Nicholas are joining us. They're going to be talking to us about their strategies and not only how to make good money, whether it is working with Astor or otherwise other advisors. It's important to see how much of that you can retain. So those strategies are something that we certainly endorse, and we'd like to see our investors, our participants come in and create the right structures for their capital. We also have with us Sebastian Lacayo and Alex Smockery, both from Astor Realty Capital. Both are part of the analysis team and the reach out and everything that goes along on the back office. And of course, everybody knows Laura, and if you don't, you should, because she's the person you're going to be interfacing with whenever we have to talk about investments and K1s and every other questions that comes along the way. So without further ado, we're going to try to wrap it up within the hour. Let me share with you our portion of GlassDoor, which really talks about, we typically bring 3 different assets to discuss on a monthly basis. And so this time around, we have, bear with me. Okay. This time around, we're going to be discussing our pref equity assets. But before we do, on a quarterly basis, we'll look at the company and we give sort of like a mark-to-market valuation. This is Q4 of 2025. And so for those of you who are new here, you know, high level, the executive team of Astor Realty Capital brings about 65 years of real estate experience and business experience. I bring 30 years. Actually, this year is 30 years. I started back in 1995 and work my way through many years in New York City, running a commercial brokerage firm that specializes in investment sales, structure finance, working with large groups, large funds, the different types of investment companies, representing on the advisory side, on the brokerage side, and even the state of New York for about 9 years on all real estate matters, where I was representing the public of the state of New York on real estate matters. So in terms of Astor, where as of this quarter, we're participating in 12 major markets, and we consider those markets to be areas where areas where we essentially look for dynamic type of markets, areas where there's growth in population, there's growth in business, there's demand, and a certain age group that is particularly of important to us, which is roughly the age of 38 years old. So those are the markets that we spend a good amount of time with. From inception for the last 10 years, Astor has participated in 37 different transactions. We have 17 exits to date, and I suspect one more this quarter, which probably will make it into 18, maybe even more than that. Overall, $3 billion in real estate assets. If you look at the overall portfolio mark to market, over 3,500 units. That's including some of them are hotel units, some of them are condos, some are rentals, but that's the overall 4.6 million square feet of very, very prominent real estate in those markets in 7 states, 12 major markets, and over $232 million that was raised and marked to market to date. Well, as I said, we're in 7 states, all the way from Phoenix, Arizona, Dallas, Tampa, Chicago, we've exited. Various parts throughout New York, with very heavy concentration in Brooklyn, New York. We've exited from Queens, we're exiting from Westchester, close to exiting from a Manhattan deal, close to exiting from a Flemington, Columbus, Ohio. Those of you that are in this deal, we've exited and distributed recently, probably less than 30 days ago. And then we have a bunch of deals in South Florida, which is a market that we're very focused on. Let's move over to our portfolio. Okay, one more. So this GlassDoor will focus on 3 transactions. The first one is called the Elevate in Dania Beach. Dania Beach is essentially a submarket of Miami. It's nestled between Miami and Fort Lauderdale, and kind of like the markets that we like. This is a 293 unit rental building. The building has been completed. It's now over 90-something% occupied. We have the preferred equity position, and we have about $4.3 million. This is a deal that accumulates 18% a year, plus we have a kicker. The kicker probably places somewhere in the vicinity of a 19, a little bit over 19% on an annual basis. We have extended, we're supposed to exit now, we've extended the exit for 1 more year. And so we're looking at sometime in September of next year as the deadline where the developer will sell the asset. It's waiting for a little bit of a better market. He'll sell the asset. Anticipation is that he'll probably going to generate north of $135 million. Great for him. Our last dollar is in the low 90s. So there's an $86 million first position note. We have the senior preferred position. It's going to be somewhere in the, call it another 7.3 million. By next year, it's going to be closer to 8. And so our position is beyond secured in comparison to the overall value that has been created. The building looks magnificent. It's something like 2.5 minutes away from the beach, direct line, Dania Beach Boulevard, beautiful area. And that's the sort of like the style of projects that we really endorse when we think about South Florida and the Miami, kind of like Miami greater area, because again, we spoke about it on multiple occasions. Miami's became a very, very expensive market. It's been pushing out a lot of the young families and young professionals. They can no longer stay in those expensive brickle markets and various other locations. And so they're looking to be half an hour away, 20 minutes away. However, go into an apartment in a building that is beautiful. You can see the lobby on the right side. It's a magnificent lobby with a pool, with amenities, workspaces, and all that good stuff. So that's sort of like what we're looking for. We're looking for that mid-market, affordable luxury, and that's where we see the biggest part of the demand. The building has been leasing out wonderfully. In some months, over 30 apartments per month, so basically an apartment a day, which just goes to explain the type of the strong demand that the market is for those affordable units. Alex, next one, please. Broadway Junction. Broadway Junction is part of a series that we're doing with the Joel Schwartz team. This is deal number, I believe, deal number 7 that we're doing together. We've created a very interesting structure of preferred equity where capital comes in alongside the developer. We created ourselves a preferred equity position. And we're working with a team that's been around the block for over 25 years, doing exactly that, building mid-size scale apartment building, ground up. They've been very, very seasoned in what they're doing. We're very happy with the results. This is 30,000 square feet rental, 51 units, basically very, very small apartments. All of them are going to be affordable under a certain program, city program. And so the building is complete. We're essentially a year into this. The building is already complete. The certificate of occupancy have been obtained. The building is in lease-up phase, and essentially we'll have a rollover option. For those who are not familiar with the deal, a rollover option means that we give the developer an option to share with us a similar property, similar like-kind property, and then we'll say, yes, we want to roll over, or we'll say, no, we want to get our money out and distribute. So there's been distributions going on a quarterly basis on this. Some of you are getting 16%, others are getting 18%. It really depends. There's three different positions, 16, 17.2, and 18%. And each and every one of you basically falls into various categories, depends on the amount of capital you have with Astor under management. If it's over $1 million, you fall into the 18% category. Distributions are done on a quarterly basis. None of it is accrual, and on an annual catch-up, which was distributed several weeks ago. We're very happy with this project. We're very happy with the progress of it. We're 1 year in, the building is complete and already in lease-up phase. Broadway Junction, 3051 Atlantic Avenue. Same structure, same type of a deal. We came in with $4.5 million. The previous one was 7.2. $4.5 million, 3-year structure. The building is already, we're 1 year into it. The building is already complete, received a certificate of occupancy, and imminently will start the lease-up period. Same type of affordable rental, preferred equity, of course, and quarterly distributions. In this one, we've done the quarterly distribution. The 4 quarters has been distributed. The developer reached us and asked for 1 quarter extension for the annual, which we granted him. And so the annual distributions, including the quarter that goes along with it, will be distributed either late December or early January. And then we will have the same option. It will take probably another 6 months to lease it up, go through the bank, refinance, cash us out, and give us another option for a rollover. Why do we do the rollover? I've been asked that before. The rollover essentially guarantees that we stay with the same structure and keep on accruing those type of returns, 16 to 18%, depends on where you are, which category of the 3 categories you are. And this is, again, one of our most popular programs with this particular developer. Great group. We're looking to do and continue doing a good amount of business together. And it really hits a lot of the spots for our investors. You have quarterly distributions, you have cash flow that you see along the way. We created a very interesting tax structure, and there's a very good reason why when we show up with preferred equity deals, specifically preferred equity deals, we tend to be, thank God for that, significantly oversubscribed. So we're very pleased with the results of these deals. I'm going to skip all conversations that we have about market conditions. I will say the following: market conditions, the overall, if you look at kind of like overall market conditions are getting better, right? And that's directly affected the fact that we are seeing, finally, we're starting to see, a break in interest rate. Again, we spoke about this before. The correlation between interest rate and valuations in real estate is essentially an inverse, right? Interest rate goes up, values go up, right? Interest rate goes down, values start to go up, and cost of capital have obviously a very strong correlation as to how the market behaves. It's been quite rough out there in the last couple of years. I would even say 3 years from the middle of 2022. And I think we're finally starting to see some relief. And the market will obviously take its time. Real estate has a little bit of a lag period. Some say as much as 2 years of a lag period. But in the professional side of the business, for the investors, for the real estate players, for the various funds, cost of capital has a very direct a very direct signal start going forward. Pick up what you can. It's still considered somewhat of a discount time, and it's probably a very, very short window before we're going to start seeing interest rate continue to drop even more, valuations going up. There's plenty of capital on the sidelines. It's waiting to come back. It looks like all the fears and all the concerns that were essentially preventing the Feds from dropping interest rate is sort of like slowly, slowly dissipating. The clouds are moving away, right? The concerns about tariffs, as for the greater part, has been pushed away. Inflation sort of like sticky. It's somewhere at the 2.5% range, 2.4, 2.6, 2.7, but sort of like hovering around the 2-ish percentage point. And overall, we're seeing that the Feds are finally starting to open up. So good news for the real estate players. And again, more of a reason for us to try and lock in as much as we can in terms of interest rate when we cut, preferred equity deals. Without further ado, I'm gonna move over to the other part of our presentation today and really give the floor to our friends, Ferdinand Ruplin, who's the president um, and Sound Wealth, Sound Private Wealth, and Nicholas Meoli, who's his colleague and an associate. We know those guys. They're very, very serious about what they do. They come with a bag of goodies that all of us should be able to enjoy. So without further ado, guys, the floor is yours. Let's hear how we can save some on those taxes.
All right.
Bird,
Thank you.
before you jump in, I just want to say, thank you personally, obviously, to Joe, to Laura, to Astor. I got introduced to Joe about 10 years ago through a personal relationship. And what's nice is we actually became friends before we learned about each other's businesses. So I can't say enough good things about Joe as a person, as a real estate professional, as a business owner. And I encourage everybody on this call to do due diligence. Look at other private equity real estate companies, because I'm telling you right now, Astor is different. There's no other company out there that structures the deals like they do. The talent that they have on their team is beyond words. So I just wanted to thank you guys for allowing us to be on here tonight. With that, Ferd, I'll kind of let you do a little bit of an introduction yourself.
Thank you very much for those kind
Thank you
words.
for having us. Yeah.
Nick. That's very nice of you.
Yes, thank you so much, Joe. Truly appreciate being here with you, and it's obviously a great platform. Nick, thank you. So to everybody on the call, again, my name is Ferd Ruplin. I am the president of Sound Private Wealth. We're a boutique financial advisory firm on the Equitable Advisors platform. And Nick Meoli, that handsome guy that you just saw a moment ago, is my colleague and a partner in the firm. And so with that, I will begin the presentation and share my screen. And let's just bring this out here. Okay. So as Joe exactly said, this is about, Joe certainly helps you make money and have the money invested well. This is about how you keep as much money as possible. And what you'll see here, this is a little bit different from perhaps the average presentation, which might potentially be around asset allocation. That is how you break up different asset classes, and certainly real estate plays a huge factor in that. This is more about asset location from a tax standpoint. So first, let me share with you that there are basically just 4 different categories in which it's possible to save or invest. And those 4 different categories are tax treatment categories. So what you're looking at on your screen now is what we call the 4 boxes. Box number 1 is the regular taxable box. So that just means anything that you earn is currently income taxable. You save that, and some examples are up there. And it just means that any earnings that you have on those investments are also currently taxed. It is the least leveraged, least attractive platform or area in which you can invest from a tax standpoint. But that being said, everybody needs to have some cash on hand, some emergency reserve, some pool of liquid capital. So, of course, there will always be some money allocated to box number one. Box number two is where we have after tax income from an income standpoint, meaning, our earned income or something like that. We paid the income tax on it. Now we have capital to go ahead and invest. And so this is after tax capital that's now being deployed. The difference is that now we're going to deploy it into areas that do not have current realized taxation. So these are tax deferred on the accumulation side. And then ultimately, when those proceeds are cashed in, redeemed, whatever, sold, whatever it may be, then there could be tax treatment on the distribution of gains at that time. And it's important that you make a note mentally of what we would call realized gains at that point. This is the box that a lot of real estate will fall into. And it's very important for you to know that long-term capital gains get to enjoy their own special tax bracket. And so they actually have taxation that's limited and lower than the higher ordinary income tax that happens once your income escalates beyond a certain range. And so it's very important to understand that by holding assets for longer than a 1 year period of time, you can potentially enjoy that long-term capital gains tax treatment. By the way, there are lots of other types of investments that you could potentially get tax deferred appreciation in, such as non-qualified or after-tax annuities of different types, meaning that the appreciation or the growth is not taxed currently, and that allows these assets to compound over time. And if you're not giving a slice of the earnings every year to Uncle Sam, that just means you're earning on a bigger pie compounded. And that happens in all of these things you see here in box number two. The third box is the one that most people, if you just approach, the person on the street and said, what's your idea of a tax advantaged type of investment platform? This is box number three. What's that? That is the tax deductible box. So this is your traditional 401ks, IRAs, pensions, SEPs, KEOs, all of those type of things, because 100 cents on the dollar gets to go in there before any income tax is deducted. And so rather than having to pay tax on earnings and then go ahead and deploy the capital, this is the full amount of money being invested right from the get-go because it's untaxed at inception. It also grows in an untaxed way, with the final distribution at the end being fully taxable under ordinary income tax. Now, it's important to point out that this box number three, this platform number three, will produce the largest pool of money at the end because all the money got invested. No money was ever taken out for any tax along the way, but then at distribution, as money is taken or redeemed, then that money will be subject to ordinary income tax at the bracket that corresponds to the amount of the distribution. So here's the maybe not so intuitive or not so obvious twist. Box number four. Box number four is where we take home our after-tax money, so we're paying ordinary income tax on earnings, and then that capital that we go ahead and deploy also gets to grow without tax. The difference in box number four is that all of the money gets to be distributed tax-free. So the original capital plus the gains. So how would you get this? This is very commonly known as the Roth-like bucket. Okay, so there are Roth IRAs. Most people are familiar with that concept, although the amount of money that you can invest into a Roth IRA is limited, as is the income. But also corporations have now begun to offer a Roth feature in 401ks, which allow the same amount of contributions as 401ks, so a higher level of contribution, that money also gets to grow with no tax and be distributed totally tax-free. Although remembering that it's after-tax dollars that are actually being deployed. And needless to say, municipal bonds, the triple tax exempt or double tax exempt interest or dividends that those pay would kind of fit into this box, meaning we could buy them with after-tax money, but we don't pay any tax on the dividends. Needless to say, the returns on those are not anywhere near the level of returns that you might see in something like the investments that we were just looking at. So there is one other little subset of this box number 4 that I would point out most people are unaware of, and that's a section of the code that is 7702. Section 7702 also allows for Roth-like treatment of investments, meaning the untaxed depreciation and tax-free distribution of gains under Section 7702 in certain institutionally priced life insurance contracts. So that actually affords people the opportunity to put significantly more money potentially than what a Roth IRA or a Roth 401k might do. And by the way, it also allows people to continue to put money into their pre-tax or deductible plan and potentially complement that with a Roth-like bucket. Here's the thing that most people do not understand intuitively. Although the money that accumulates in box 4 will be a smaller amount of principal because after-tax money was invested, the actual net distribution, if we assume the same tax bracket during the accumulation phase as the distribution phase, then the same amount of money net will be produced by both box 3 and box 4. So there'll be a smaller pot of money in box 4, but 100% of the money gets to go without tax into the pocket, whereas box 3 will have a bigger amount of money, but it gets reduced by the tax bracket at that time. So again, just to drive the point home, if you assume the same tax bracket in the accumulation phase as the distribution phase, both boxes 3 and 4 are the most tax efficient of the boxes. So let's move along and see how this actually impacts the overall planning. And to do that, we need to consider that not only are there accumulation and distribution phases, but also there are ultimately asset transfer. There's ultimately an asset transfer phase. So most of us are very focused on what happens as we build up our investments. And certainly to a great extent, we're focused on how much we're going to be able to enjoy the proceeds of those during our lifetimes. But I think most of the people that are involved in this type of conceptual saving and investing also have a thought that they'd rather not have their assets scalpelized and destroyed by the tax man if and when they distribute those assets to their heirs ultimately. So there are actually 3 different phases of wealth management that should probably be considered in a holistic way. So really, this is the interesting difference between most financial presentations, which talk about the traditional strategy, which the traditional strategy is try to max out on your tax deductible contribution, enjoy tax deferred accumulation, but not really taking into consideration the fact that those distributions are going to be significantly haircutted either during lifetime distributions or ultimately upon passing those assets to their heirs. So just to make a point on that, the worst possible inheritance to heirs is a qualified retirement plan, meaning an IRA, a 401k, SEP, KEO, pension, anything like that. So what we're really referring to here is an expanded strategy that would not only include the tax deductible contributions, untaxed accumulation, but a portion of tax-free income. And so I guess this is a good time to also point out that properly structured real estate investments can produce tax advantage distributions also through depreciation. And they also enjoy that special tax bracket of long-term capital gains if the assets are held longer than 365 days. So thinking about this more in an expanded light, that it really helps if you consider about how these are going to play when you benefit during your life and ultimately transfer those assets to your heirs at the end. So 4 important considerations: liquidity, obviously being able to access assets, and the different boxes have different rules around accessing assets. Certainly box number 1, you can take your money anytime. Box number 2, many of those things may, if they're things like non-qualified deferred annuities, they have that age 59 and a half restriction. However, long-term capital gains, they don't. You just have to hold them for a year. So that has liquidity during lifetime. Diversification. Is there a way in those different 4 boxes to have assets that are invested into different asset classes? So a little asset allocation, meaning having exposure to equities in the form of stock equities, equity in the form of real estate equity, and other types of investments, fixed income contracts, whatever it may be. And then, of course, the ideas of making sure the maximum amount is passable to heirs. But here's the last one we didn't touch on so far, creditor protection. Once we do build up a certain amount of assets, unfortunately, acknowledging the reality, the pure fact that we do live in this litigious society today, if there's a way to also build in creditor protection around our assets, that could be very advantageous as well. And certainly qualified plans enjoy creditor protection, but so too do some of the other features of box number 4 that we'll remind you of in this. So this is a very simple slide, people. This is just like, what are you really paying in tax? And so obviously, if this is like, simple arithmetic, if you earn $100,000 and you're only in a realized effective tax rate of 10%, well, you're taking home $90,000. If you're in a realized effective tax rate of 40%, well, 40% of your revenue is going away. It's important for me to make mention of the fact that this is not exactly how our tax system works. We are actually in a marginal tax rate system, meaning different brackets of income do get taxed at different rates. And we're going to look at that in 1 second. So here is the 2025 marginal or progressive tax rate schedule. And the important thing I want you to take away here is that this is the tax, the actual tax that gets paid on a couple married filing jointly of their adjusted gross income. So first of all, most people, because unfortunately due to the SALT tax deduction limitations, which are being massaged a little bit as we speak, but unfortunately, most of us are still better off just going with the standard deduction, which we'll look at in 1 sec. But after that, any adjusted gross or taxable income, the 0 to 23,850 is a very economical 10% realized tax. 23,850 to 96, 12%, not so bad. And as you can see, as you work your way up through those brackets, if you have an earning married filing jointly that's under, say, 500,000, your real tax is probably coming around somewhere in the mid-20s. If you're, 750 or over $1 million, depending how far over $1 million you go, you might still be in an effective or realized tax rate of 30% or something like that, because a bunch of money is being taxed at lower brackets. How does this play? Well, what I want to share with you is what I just said. You have a standard deduction, so we have the $15,000 per person. If you happen to be 65 or older, you're getting another $1,600. So theoretically, the first $33,200 of actual flow is non-taxable because you have that standard deduction. So there's no tax being paid on that. And what we're showing here is a scenario where, let's say somebody gets to that point and they're taking $57,000 out of their IRA. That's a contrived number that I came up with so that I can show you what the standard deduction does to that. Because taking the standard deduction of 33.2 if you're 65, that leaves you with that taxable income that maxes out in that first tier, and it's only 10%. So the interesting thing about that, in combination with standard deductions, is that you're only paying 4.18% of actual tax on that distribution. So, sadly, I think most of us on this call are not surviving on 57,000 of an IRA distribution, right? But the premise is that you have a way of minimizing taxes. And I think what I'm going to share with you now as we work up the income scale is how you can really take advantage of the boxes to maximize or optimize this way of structuring your savings or investments. Oh, why is my slide not advancing here? What happened? Oh, here we go. Okay. So now let's think if we have perhaps some long-term capital gains involved in the equation. So here's the federal long-term capital gains rate. This is fantastic, especially if you happen to own some real estate investments that you hold longer than a year. So for married filing jointly, if your total adjusted gross income comes in under 96,700, so that means the gain on a property sale plus any other income you have comes in 96.7, you're paying zero on capital gains. Oh my God, that's unbelievable. All right, we still may not be able to survive at our standard of living on 96,700 married filing jointly, but nevertheless, look at the next bracket. 96,700 to 600,000 is 15%. So that's pretty attractive. So in this example scenario, if we had the 96,700 and we had our ordinary income tax tier at 23,850, we could make 72,000 of capital gains and be at zero. So that's kind of an interesting thought right there, submitted for your consideration. Let's ratchet this little game up a little bit. So let's take some money out of an IRA, 57,000. So we know we're only paying $2,385 of federal tax on that. Let's say we have this long-term capital gains investment, and keep in mind, when you cash in a long-term capital gain investment, the entire proceeds are not gain, right? Part of it is your principal. Your principal, you get to have back for free. That was after tax to begin with. So in this example, I'm saying we invested $60,000 and we sold it for $120,000. Sounds like one of the investments that Joe was just talking about potentially. So you have $120,000 of total gross, but 60 of it was return of capital. So only 60 of it is gain. So in this example, we have a $177,000 total flow, and we're still only paying $2,385 of tax, which is a 1.3% realized tax. All right, I know none of us here can actually live on 177,000, so we're going to ratchet this one up again and take a look at the next scenario here. Let's see, here we go. Oh, all right, let me not forget about Social Security. So this is just a caveat. I'm throwing this one out there. So we don't want to take Social Security before full retirement age if you're making any earned income. So this is the thing. If you have over 23,400 of earned income and you take Social Security before full retirement age, which for most Americans nowadays is age 67, then they're going to take back $1 out of every $2 of earnings over that limit on the Social Security. So it's totally not worth it to take Social Security until you're at the full retirement age. Just keep that in mind. All right, let me give you an example. Sorry, this is a little bit busy, but I just want to give you a couple plays on taking flows of income. And I understand this is probably too low of income for most of us for the New York metro area people or Miami metro area people. But let's just say hypothetically we have 30,000 of Social Security, married filing jointly again. Now we're only taking 25,000 out of IRA. We sell an asset for 50 grand, but half of it right here is gains and half of it is return of principal. So we have 100,000 of total distributions. Well, guess what? At that level, we're only paying this is New York, is a little New York State is included in there too. So we're only paying $2,548 of total tax. Total. Effective tax rate 2.42. $8,500 a month in the pocket. All right, let's take a look, because so far we haven't even included 1 penny of that quadrant 4, box 4 Roth-like type distribution. So let's say we actually created a little bucket of money in that platform. And so we take our Social Security, we take our IRA, 25 grand, and we sell that long-term capital gains asset for 50, 25's principal, 25's gain. And we now add 25,000 distribution from the Roth-like bucket. 130 gross now, still paying the same tax because there's no tax on that quadrant 4. Now we have total net in the pocket income out of that 130 of 127. Tax rate 1.96. Pretty good. Okay, I get it. You guys can't live on 130,000. So let's ratchet it up a hair here and take a look at a little bit more of a capital gains distribution and taking the full bracket 1-2 IRA distribution. So Social Security, 30 grand. IRA distributions, 54.3. That was that magic number. Now we're selling 120,000 capital assets. 60 is principal, 60 is gain, 204,000. Well, we're living still in the first 2 marginal brackets, so 10 and 12. So now the total federal and state tax on 204,000 is $12,000. Our net income out of 204 is still 192 for an effective total tax rate, federal and state in New York, of 5.96. All right, we did not include box 4, quadrant 4 income in that. So let's flip over to where maybe more of us want to be, and that's in a lifestyle that calls for a little more cash flow on a monthly basis than 16,000. 30,000 Social Security, 54 IRA, same figures. Long-term capital gains, same 120, half principal, half gain. Now we take 100,000 a year out of that quadrant 4, 304,000. Did our tax change? Not 1 penny. Total net income out of 304,000, 292. We've reduced our effective tax rate to 4%, and our net monthly income, $24,000 a month, which is, maybe it's 700 a month or 800 a month less than the actual gross. So that is an incredible way to optimize your cash flow in the premise of having equal buckets of money in the different areas and the different platforms to allow those distributions. So, takeaways. Ordinary income bucket, try to the extent possible to stay in that 10 to 12% bracket. Now, some of you are not going to be able to do it. However, if you still stay under the 394,000 of adjusted gross income under 394, you're still only at you have some of the money at 24%. So a good chunk of it, all the way up to 206,000, is being taxed at much, much lower rates. And then your capital gains, to try to keep that within the 0 to 15. Many of you won't be able to make the 0 with that $96,000 threshold. However, even up to $600,000 of aggregated income, you could still only pay 15% capital gains. Now, if you're selling a big asset, the gain itself might be more than $600,000. I don't know. But the good news there is that the federal tax on that is still capped at 20%. That is massively lower than the 37% you might be in if you're above 750 of total adjusted gross income, married filing jointly. And then the last concept is supplement these plans with that quadrant 4 tax-free sleeve, that tax-free bucket. Because if you can take money from all 3 of those most advantageous spots, that's box 2, 3, and 4, then you can reduce your overall tax rate down to the lowest possible net realized amount. So the questions to ask yourself: have you started accumulating assets that enjoy that tax-free distribution feature? And, keeping in mind that it's a progressive tax system, try to keep yourself down into those brackets. Even concepts like the Roth conversion or backdoor Roth or backdoor super Roth, if you're below, there's a big amount of money you can earn under the 32% bracket. You don't want to go into 32, 35, 37. If you can keep your overall income down into that below the 32, and there's a big gap between 26 and 32, you can actually convert those qualified plan 401k traditional IRA pension monies into Roth. And if you have enough time to let that reappreciate, it can really make a difference in how much you will receive later. And by the way, it'll make a big difference if you ever wind up leaving any of those assets to your heirs too, because those get to pass completely tax-free. By the way, I didn't mention the beauty of passing assets to your heirs that are long-term capital gains assets like real estate or long-term stock holdings or anything like that. Because your heirs, if they're non-IRA assets, they get to receive what's called a step up in cost basis. You might have bought that property for $100,000 and now it's worth $1 million. If you leave that asset to your heirs and they turn around and sell it, their cost basis will not be the $100,000. Their cost basis will be the value on the date of death. So odds are there'll be no capital gains to them if they need to turn around and sell those assets later, or even if they sell many years down the road, at least their cost basis will have been reset to that higher level. One of the greatest tax breaks is the step up in cost basis at death for heirs. So it's a very good idea to assess your whole picture and try to identify how you can have not just an asset allocation strategy, but an asset location strategy from a tax standpoint. That's pretty much all I have for you all this evening. I can toss it open to questions if any of you have anything that you want to throw out. Joe, back to you.
Thank you
Well,
very much, Ferdinand.
Joe, real quick, one thing I just wanted to mention was looking at the returns that Astor is providing you, talking about, different types of tax consequences, tax buckets, so to speak. Speak with Joe, the team. You could actually leverage your retirement assets to invest with Astor. So going back to those Roth-like buckets, imagine getting those 20% returns every year and not having to pay a single dollar in tax on them. So there's different ways that you could leverage your existing portfolio if you're not sure how. That's what we're here for as well. You have access to us, reach out. We're here to help. We're here to answer any questions. But it's very nice to be able to get those, double-digit returns and not have to worry about paying any taxes on that money.
Thank you, Nick. With this in mind, where do you suppose is the right time for planning? Is it accumulation? Is it closer to retirement? What do you think is the right structure and when?
So, Nick, you got that, or you want me to answer that one?
Well, I'll say, yeah, Ferd's got a few more years of experience on the planet than I do, and has been in the industry a lot longer. That being said, with my 10 years of experience in the business, any time is a good time. Right now is a good time.
Sooner the better. That's exactly what I was going to say.
It is never too soon to start, because what you need to do when you're young is you need to always pay yourself, and you need to take advantage of time value of money and compound interest.
Yeah.
And if you're on this call or you have children that may want to get involved with Astor or with investing and take advantage on a tax standpoint, they need to start building that capital now. And they could take advantage of these retirement vehicles, investment vehicles, either through their company, through the outside individually, and actually start building up those buckets of money, start seeing those compound, and then you have enough there to be able to invest with Astor and then get those double-digit returns on a very tax advantage basis. So I would say right now is the good time, and there's no better time than now, or the sooner the better.
Mhm. Yeah, no, it makes perfect sense. I mean, we have typically when we do condo deals, and God knows, when we do those deals, this is basically ordinary income, it's straight into ordinary income.
Mhm.
But we really push for folks to start a Roth IRA and get the money through a Roth IRA
Mhm.
because that's just the right way to go. Otherwise, the taxable impact is just so large. It
Mhm.
makes no sense to take that type of a risk if the end result is going to be sort of like double digits into the low teens, right? We want to make sure that when we do those type of projects, we are somewhere in the 20 plus net to our investors and that they retain as much as that is possible. Talking about Roth IRA, everybody wants to be in box number 4. What's the maximum contributions can happen, and what's the best structure do you suppose for Roth?
So, great question, Joe. A regular Roth IRA is probably not going to be that useful for the average person on this call because, number one, the annual contribution limit, if you're under 50, is $7,000. If you're over
Okay,
50,
that's
it's
very
eight.
low.
It's
Mhm.
very hard to build up any kind of money. Now,
Right.
that being said, um, you can do Roth conversions. So, if there's somebody who's, 48 years old or even 50 or whatever it may be, and they have a pretty decent amount of money that's now accumulated inside their 401k, the box 3, you can take advantage of Roth conversion.
Okay.
Now, the strategy with doing Roth conversion is that you don't want to crush yourself in income because you have to pay tax when you take it out of that bucket, right? So,
Hmm. Hmm.
so the idea is if you look at the brackets, there's definitely a sweet spot depending upon your regular earned income. So if people are earning, a couple 100,000, they still have a lot of leeway that they could potentially take money out of the traditional and convert it into Roth and still be only in the, maybe 22, 26, in somewhere in that tax bracket where it's not rock crushing tax like, the 32 or the 37 or anything like that. So once you have too much income, it doesn't pay to convert. But if you're at a modest level, you could potentially convert chunks. And then when you invest, that all those proceeds totally tax free. So that's a one strategy of doing it is a conversion.
Any other good strategies for conversion from a traditional to a Roth, or
So
maybe from a traditional to something different?
something Roth like. So the other thing is, I was just talking about like what do you do with the money? Like many
Hmm.
people get way overloaded in bucket 3, like in box 3,
Right.
because
Right.
everybody's told since they're 20, like put the money in the 401k. So it
Right.
gets really big, and which is fine. And the conversion thing is out there. But if you have other income, other like regular
Hmm.
money that you've already paid tax on, and you're thinking about, okay, where do I invest this or something like that,
Hmm.
that's possibly where that Section 7702 portion of the Internal Revenue Code comes in, which can allow for pretty much unlimited investments properly structured into funds. So, S&P 500, yeah, whatever, those types of funds.
Hmm.
Um, it's not really because it's in institutionally priced life insurance, so it's a little more challenging to be able to invest into a program like Astor under that because these programs are kind of packaged already
Hmm.
with
Hmm.
the investment options.
Right.
However, if somebody had 7 figures or more that they wanted to do, then there are things out there called PPVLI, which is private placement, and that could potentially create a Roth-like environment for a bigger chunk.
Hmm.
Um, Those they're pretty rare in the industry out there, but people with, I've had people do it, that are hedge fund managers and they have like hundreds of millions of dollars and they're like, how do I throw 5 million a year into this or something like that, and
I see. Okay. So it
so
depends on, so for maybe for larger brackets or for larger
yeah,
buckets
yeah,
rather, not brackets,
yes,
but for
correct, correct.
larger
Yep, yep,
buckets, there
yep.
are some solutions. We have a question here from one of our participants. If you can expand a little bit more about the insurance policy in box number 4.
Yes. So life insurance of all types actually enjoy the same tax treatment under Section 7702, which provides for the untaxed accumulation of values inside of a policy, and Section 72, which covers for distributions that allow those distributions to be made tax-free as long as the policy is not terminated. Because under that scenario, all the money that builds up and then is distributed during life and ultimately to beneficiaries is considered to be part of the overall survivor or death benefit. And death benefits under Section 72 are totally income tax free. So the one big caveat, Joe, is that you need to make sure the policy stays around for the rest of your life. If you're making hundreds of thousands or millions of dollars of lifetime benefits, you want to make sure that that thing's still hanging on there the day you die when you're 100 or whatever it is, and then all the money winds up being tax free. Now, I qualified that by saying all policies enjoy that treatment. The issue is the old fashioned types of policies, like traditional whole life or traditional universal life, they have very low rates of return. So, it's like, why not just buy municipal bonds and get 3% tax exempt? It's not that attractive.
Right. It's boring.
Yes, especially when you're talking about, Astor returns 18% or 16%.
Right.
If you want that type of return, the only way you can get that is by having an equity stake in things that can grow, right? So that's why I reference variable life, because that chassis allows for investment into hundreds of different investment options, which are more or less aggressive depending upon what somebody wants to do.
Thank you for that. We're at the top of the hour. I'm going to ask you one last question, guys. Highly appreciated real estate assets. How are those treated when they die? And you touched on it before, right? You touched on it before. You bought an asset.
Good question. So there are a couple things with highly appreciated real estate assets. And, sometimes there are very sound reasons why someone might want to exit from one property during life. And so there is a section of the code, Section 1031, that allows like-kind exchange where proceeds can be rolled into a new real estate investment. And, there are certain parameters that have to be adhered to in order to do that. But then the gain gets to be rolled over, okay? And so that's one way of deferring having to pay tax on highly appreciated real estate assets. The other big break that was given is the $250,000 exemption per person on their personal residence. A lot of the investments we've been talking about today are not our personal residence, but that's something that is a tax break that's now been around for a while. And then the last one is, the best tax break is if you leave a highly appreciated real estate asset to a beneficiary, to an heir, to a son, daughter, children, whatever it may be, they get that step up in cost basis, and especially investment real estate, because as we know, we're depreciating the heck out of that thing during its lifetime, because that helps you get better treatment on your income. And so at the end, you might have a very, very low cost basis and a high appreciation value. But if you leave that to an heir, their cost basis will now step up to the date of death value. So they could have very minimal to no capital gains if they sold.
Very interesting. Thank you very much, Ferdinand, Nicholas. I appreciate you coming, joining us, giving us a lot of those pearls. It's been very beneficial. Laura has shared your contact information here. You can find it on the comments information of how to reach Nick and Ferdinand. their phone number, contact, website. Great guys. Feel free to reach out, have questions, have one-on-one conversations. We obviously just touched the surface. This is a highly tailored, highly curated type of a conversation. Everyone's a little bit different. Everybody's situation is unique. And, you know, we have those amazing guys here, and I really appreciate you both for coming and sharing that with us. We're also going to share this conversation and the contacts of Ferdinand and Nicholas, so everybody will have that. You'll have a chance to go and revisit it if you have a need to. And of course, feel free to reach us also if you have any questions in regards to your investments or future deals that are coming about. I want to thank you all for joining. Thank you again, guys. Thank you, Laura, Alex, and everybody else from my team. I appreciate you all. Have the rest of the evening pleasant.
Joe, thank you. Thank
Thank you,
you.
everybody.
Thank you, gentlemen.
Have a great
Greatly
evening.
appreciated.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
I feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.